When the New York session opens, gold, trading as XAUUSD, routinely explodes upward, covering dozens of pips in a matter of minutes. Retail traders watch that rapid climb, fear missing out, and buy right at the peak. Almost immediately, the price snaps back down, hitting their stop losses and taking them out. That snapback happens because large institutional players need massive amounts of liquidity to enter their own positions. Look at this diagram showing a classic stop run. Institutions deliberately push the price below an obvious support level to trigger a cluster of retail stop-loss orders. They buy those cheap orders to fill their own massive positions before reversing the direction. Instead of becoming the liquidity for these large players, you can wait for the specific visual footprint they leave behind when they execute this move. Gold's high volatility creates these structural footprints. If you know how to read the chart, you can map precise locations of the smart money. The first half of this footprint is an ICT concept known as a breaker block. This sequence shows a breaker block in action. After an uptrend sweeps a recent high to hunt liquidity, the price aggressively crashes lower, breaking straight through the previous swing low. Pay attention to that final upward closing candlestick right before the drop. Originally, traders expected it to act as support. Now that price has broken through it, it becomes our breaker block. When the price eventually returns to that zone, institutions actively defend the positions they built during their initial trap, turning that old support into a heavy wall of resistance. This broken level gives us clear structural evidence that large players have trapped retail buyers and flipped their direction. A broken support level alone won't confirm a trade. On a highly volatile asset like gold, you need to see displacement. This illustrates the difference between a lazy pullback and actual displacement. True displacement is a forceful burst of energy barreling straight through previous price levels. Notice the three large downward candles in this displacement. Because the drop is so fast, there is an empty vertical space left between the bottom wick of the first candle and the top wick of the third. This is a fair value gap. The ICT Unicorn Model requires this fair value gap to be nested right inside or perfectly overlapping with the body of the breaker block. A standalone gap can be filled and ignored. A standalone breaker can be messy. Combining them isolates a dense, dual-layered zone of institutional interest. The breaker block is a visual record of the failed stop run, while the fair value gap marks the path of the aggressive displacement that followed. By directly trading the overlap, you are entering at the exact intersection of structural failure and institutional momentum. Warning tone. Even a perfectly formed unicorn pattern will fail if you try to trade it at the wrong time of day. Look at the New York Stock Exchange. The New York session is when gold sees its highest concentration of institutional trading volume. This is the silver bullet window, stretching from 10 a.m. to 11 a.m. Eastern. After the initial chaos of the open settles, this hour provides a window where high institutional volume typically aligns to drive the market's most sustained directional move of the day. If a unicorn setup forms during a dead zone late in the day, or 30 minutes before a major economic news release, the market lacks the sustained volume to make it work. By utilizing time and price as filters, you drastically reduce your exposure to retail noise and isolate the setups with the highest probability of moving 50 to 100 pips. Once you identify a valid unicorn during the silver bullet window, you have to pinpoint the exact micro level for your entry. This diagram zeroes in on the overlapped zones. We measure two specific 50% marks: the mean threshold, which is the exact midpoint of the breaker block, and the consequent encroachment, the exact midpoint of the fair value gap. Locate the exact price where those two midpoints sit closest together. That is where your limit order locks into place to maximize your risk-to-reward ratio. Gold frequently makes one last attempt to hunt for liquidity before dropping. Protect yourself by placing a conservative stop-loss safely above the highest swing point that initiated the displacement. You are no longer reacting to sudden price spikes. You are waiting for a mathematically precise setup to trigger your entry. Because the margins are tight, this execution requires a platform like FXNX, where zero pip spreads and ultra-fast execution ensure your limit order fills exactly where you place it. Open your XAUSD chart on FXNX, scan the last 5 New York sessions for that overlap, and claim your NX Boost bonus to put the ICT Unicorn Model to the test today.